Bloomberg 99.1 to Boston, Bloomberg 106.1 to San Francisco, Bloomberg 960 to the country, Sirius XM Channel 119, and around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
Yes, indeed. This is Bloomberg Business Week. Carol Master along with Kaylee Lines. Coming up, we've got Dave Wilson and his chart of the day. I know you follow this, don't you?
Oh, I do. I'm an avid fan of Chart of the Day, but I'm just really excited to hear what Dave's song is going to be. This is very hyped. I'm very excited.
Yep, and you're going to have to guess it, so that's a little bit of pressure. All right, we'll get to that in just a moment. Let's get back to your top business stories. A check on that trading day. Charlie Pellet, 29 minutes to go.
Indeed, the Dow, the S&P, NASDAQ all trading lower. S&P heading to its biggest drop in a month on concern that rising coronavirus cases will hurt the global economy. Also, prospects are dimming for fiscal aid from Washington ahead of the presidential election. Right to the numbers with the Dow Jones Industrial Average down 735 points, down 2.6% at the worst level of the day. The Dow had been down 965, down 3.4%. The S&P is down 71, a drop of 2%. NASDAQ lower now by 218 points. For NASDAQ, a drop of 1.9%. 10 years up 12.30 seconds, 10-year yield 0.79%. Gold right now little changed, up 65 cents the ounce at $19.02. West Texas Intermediate crude down 3.3%, 38.54 a barrel. WTI now lower by 1.3%. A COVID vaccine candidate developed by the University of Oxford with AstraZeneca has produced a robust immune response in older adults and the elderly, those at highest risk of severe illness. AstraZeneca ADRs are up now by about 1.7%. The finding comes amid a record number of COVID cases in the United States. Dr. Joshua Sharfstein is Vice Dean at the Bloomberg Johns Hopkins School of Public Health.
You know, Tom Inglesby from the Johns Hopkins Center for Health Security was quoted over the weekend saying something which I think is true. The cases are going up, and we're not really doing that much to bring them down. So we're going to expect them to go up for a while. And when that happens, more people will get sick, and that's what's driving those projections that more and more people will be dying.
The Johns Hopkins Bloomberg School of Public Health is supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. Tomorrow morning, we'll be hearing from drug maker Pfizer. Along with Merck, analysts say any comments that Pfizer has to make about its COVID drug will overshadow per share or revenue numbers. Today, we are looking at shares of Pfizer, and they are trading lower now by 0.8%. Merck shares also reporting tomorrow morning, down now by 1%. Recapping, S&P down 69, a drop of 2%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. You're listening to Bloomberg Business Week, and this is Bloomberg.
Okay, is the question who wrote the song, or is the question...
Did the Beatles write it?
No, they did not.
They did not write it. That's a very Beatles feel. Three Dog Night?
Right, they sang it, they had the hit. I actually mentioned it, I'm going to tell tales out of school for a sec.
Okay.
You know, Kaylee and I are on the same team.
Yes.
And, we have a weekly sort of Zoom-type call where we get together, and the subject of Three Dog Night came up, and I mentioned this song.
Come on, Kaylee, where were you? Were you listening?
I tried to give it to her.
Dave,
She didn't take it. I'm so
and you know what?
disappointed.
The worst part about this is I asked Dave to give me a hint, and he said no, but he did one in a sneaky way anyway, and I just didn't pick it up at all.
You know.
I appreciate the effort, Dave.
Hey, I
You
do.
tried to help me out.
Anyway, it was originally written by Randy Newman.
Oh, wow. Okay.
Yep.
Okay, wow. There's a lot of people.
In any case,
Okay.
why pick that song? Well, I mean, because of this discussion in part that I was talking about earlier, but also, if you look at the weight of energy stocks in the S&P 500 right now, the number begins with a 1. or at least it has within the past week or so. Last week, it got down to 1.96% on a closing basis. Now, why does that matter? Because basically, if you go back through the history of the S&P 500's main industry groups, sectors, if you like, there used to be 10, now there are 11 because real estate was broken out separately.
Mm-hmm.
You really can't find a sector that's had much lower of a weight over time. Phone companies, for example, before the index got reorganized and telephones became communication services, it got down to about 1.75% in June 2018, just before that transition into the communication services.
Right.
And so what I did is just go back and look at the end of each year, going back to 1990, when this current set of sectors was put together, and say, okay, what was the lowest weighted industry group over time? And for a lot of years it was phone companies, it was utilities, sometimes raw material companies. I'll tell you what surprised me, though. If you go back to the early 90s, it was technology.
See, isn't that interesting? Just shows you how things have changed.
Oh, absolutely.
And our world has changed. Yeah.
Yeah, and if the energy were to stay where it is, it would have the lowest year-end weight ever for any industry group. And you talk about how things have changed, certainly with the growth of renewable energy, which, by the way, would be in this index that we're talking about, the S&P 500 Energy Index. If there were any renewable energy companies at all in the S&P 500, in other words, it could be classified there, but it's not there because it's just not in the index at all. So in any case, that's why you get a number that's as low as the one we're talking about, in the ones.
Yeah.
And if you want to know more, folks, send me an email. I'll get you the chart, the explanation that goes with it, and everything I do going forward. The email address is dwilson@bloomberg.net. That's dwilson@bloomberg.net.
Well, it's a reminder of kind of where the industries and maybe the fading fortunes of it, right? I feel like you go back 10 years, 15 years, like you just constantly talked about the importance of the energy sector, but it's just the changing dynamics, Dave, of our marketplace and really our world, our greater world.
And it's kind of like the flip side of these charts you've seen lately with like the top 5 stocks or 25% of the S&P 500 or whatever. That's what's dominating the index. Here's what's not.
Yeah. And Carol, we should note stocks down 2% overall for the S&P 500 today. Energy, bottom of the pack from a sector perspective. It's off about 3.5% right now.
Yeah, it's a sector that we've seen constantly, right? If you look at those major industry groups in the S&P 500, often at the bottom of the pack. They've really been a beaten up group. All right, Dave.
As we speak, 1.99%.
Nope, still a 1.
Yeah.
Still a 1.
Just about, right? All right, Dave Wilson, thank you so much. Dave's going to be along a little bit later on with his stock of the day. And as you mentioned, if we look at those major averages, as you said, Kaylee, S&P down about 2%, Dow off about 2.5%, and the NASDAQ down about 1.9%. We're coming off our lows, but nonetheless, we're definitely down across the board. Let's get back to world and national news. For that, over to Nancy Lyons in our 99.1 newsroom in the nation's capital. Hi, Nancy.
Hey, Carol. President Trump is looking for votes in Pennsylvania today, predicting a win in a state he needs.
People have no idea what's going to happen in Pennsylvania, that I can tell you. I know Pennsylvania.
Democratic vice presidential nominee Kamala Harris was on ABC's The View this morning trying to clear up confusion about the Biden tax plan.
We will not raise taxes on anyone making less than $400,000 a year. Period, full stop.
Biden this afternoon is making a stop in Chester, Pennsylvania, and will be on the campaign trail tomorrow in Georgia. Well, the U.S. Senate has been playing out the final hours of scheduled debate on the Supreme Court nomination of Amy Coney Barrett. Bloomberg's Irv Chapman reports.
The arguments are by now familiar. Democrat Richard Blumenthal.
What's happening today is sad, surreal, even shocking. Amy Coney Barrett, as a member of the United States Supreme Court, will shift radically and dramatically the balance politically on that court.
Republican Todd Young.
I urge my colleagues to come together to carry out the will of the American people. Judge Barrett has proven that she will make her decisions based on the law rather than politics.
Confirmation is to be voted on this evening with a swearing-in to follow. In Washington, Irv Chapman, Bloomberg Radio.
Well, the Kentucky Fried Chicken Fire Log is back. This will be the third consecutive holiday season fans can purchase the fried chicken scented 11 herbs and spices Fire Log. KFC says the Fire Log is designed to make your home smell like fried chicken and feel as warm as an extra crispy drumstick. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nancy, thank you so much. And who doesn't want their home to smell like fried chicken?
I do. I love me some KFC, Carol.
KFC. Homemade is what you got to do. Homemade fried chicken is the
one
best.
of those buckets.
All right, so a couple stories we want to bring your attention to right now that are trending high on the Bloomberg, including U.S. House Speaker Nancy Pelosi and Treasury Secretary Steven Mnuchin apparently spoke for 52 minutes, so almost an hour on the stimulus bill. So that is coming out and on Twitter right now. So we'll continue to track that and see if we get any progress when it comes to stimulus. I mean, this is what we're seeing because this is why you're seeing markets lower today.
Right.
A big part
I mean,
of it.
the odds of a stimulus deal happening before the election, which, oh, by the way, is a week from tomorrow, is looking like it is less and less likely. Both sides accusing each other of moving the goalpost. It just does not seem like we're really getting fundamentally closer to reaching any kind of deal in the near term, at least, Carol.
Yeah, and those comments coming from Drew Hamill, who is the Deputy Chief of Staff for U.S. House Speaker Nancy Pelosi. Yeah, it's kind of shocking. We've had these conversations before on air about here we are, a week and a few days away from the election, and it's amazing that you would think that the Republicans would want to get this done, and yet it's not happening. In the meantime, a couple of stories on the Bloomberg. The one that really caught my attention has to do with BlackRock. It's the world's largest asset manager, downgrading its views on U.S. government debt, even as treasuries retain their value as a haven, as we've seen stocks sell off today. But that's pretty fascinating.
Yeah, and it's because of this blue sweep that everybody's been talking about, Carol. And it's interesting, a lot of the calls coming from Wall Street on the blue sweep is that it's actually going to be positive for equities because it's going to mean lots and lots of stimulus, more green spending. That at least is the prevailing narrative at the moment. The question is, do we get a blue sweep? Do we even get a blue president? The polls are narrowing. The market, maybe today, some of this losses we're seeing is factoring that in as well.
Well, and what's interesting is, listen, BlackRock, we know they are all in when it comes to fixed income assets. About $2.5 trillion of their $7.8 trillion is in fixed income. So this is why when they make a call like this, you definitely listen.
Oh, yeah.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. 13 minutes to go ahead of the closing bell with the Dow, the S&P, and NASDAQ all declining. S&P on track for its biggest drop in a month on concern rising coronavirus cases will hurt the global economy. Also, prospects are dimming for fiscal aid from Washington ahead of the election. Losses for energy and industrial companies sent the benchmark gauge down 2.9% at one point. Those stocks paired losses in the afternoon amid recoveries for the biggest tech companies. Indeed, a busy week for tech earnings. Here's where we stand with the S&P now lower by 79 points, down 2.3%. The Dow is down 780, down 2.7%, and NASDAQ is down 234, a drop of 2%. 10-years up 13.30 seconds, 10-year yield 0.79%. Gold higher, little changed, up less than 0.1% right now, up 88 cents at 19.02. West Texas Intermediate crude oil down 3.4% at 38.50 a barrel. Recapping, stocks lower, S&P down 81, down 2.3%. I'm Charlie Pellet. That is the Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
Just drive, baby.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
It is time for the Drive to the Close right here on Bloomberg Business Week. Carol Master along with Kaylee Lyons. We've just got about 11 minutes left in today's trading session. Back with us, and great to have back with us, is Randy Watts. He's Chief Investment Strategist at O'Neill Global Advisors. He's with us on the phone in Washington, D.C. Randy, how are you?
I'm good. I hope you and Kaylee are healthy and safe in New York, and everybody's all right up there.
Yeah, doing okay. Thank you. We're watching the markets, though. Investors, definitely, it's a risk-off trade kind of day. I think disappointment, safe to say, and concerns about those rising virus numbers that you just mentioned, Randy, and then concerns that we haven't gotten some kind of aid package through again. How do you see the current trade right now?
I mean, I would agree with the first two things you said. I would add a third, which we've talked about previously, which is the election. Yeah. The election's going to be close. There's a lot of uncertainty about what's going to happen. And I think people, again, are nervous that when we wake up on November 4th, we may not know who won the presidential election. And then there's a question of how long is it going to take to figure that out. Markets don't like uncertainty. Fiscal stimulus uncertain, election uncertain, and COVID ramping up again, another uncertainty. I think all of that really gives investors a reason to take profits after a heck of a run since the lows in March.
Randy, what makes you most nervous? Is it the prospect of a contested election, or is it the ultimate result? How do you think about a blue wave or a second Trump presidency?
I mean, historically, mathematically, the market does a little bit better in the first year of a second-term president than in the first year of a first-term president. Though I think a lot of that is because normally, if an incumbent president loses, he or she loses because the economy's weak, right? I think what makes me nervous is not the result of the election. It's the idea that we could have an extended period of time of uncertainty, not knowing who won. I know there's been some speculation from states like Michigan that it could take them a week to count all the votes, and I think the market would not like that.
Well, so how do you, or what are you thinking about in terms of positioning ahead of the election because of that, or are you, Randy?
Well, normally the market is actually following the script today. What's funny is it hasn't been following the script up to this point for the month. Normally the market is down in September and October going into the election. After the election starts to rally in November and has a strong December. So what's really unusual is the fact that the NASDAQ and the S&P are both up month to date, and actually still are, going into today. Normal action is for investors to take some profits off the table before the election occurs.
Right, and of course, in addition to the election, in addition to stimulus, in addition to a pandemic, it is also earnings season. It's the biggest week of earnings this week, Randy, $15 trillion in market cap reporting. do we care, or is it all about those first three things I just mentioned?
We do care. Earnings season has gone pretty well. 28% of the S&P has reported so far. 86% have come in positive, so ahead of expectations. 13 have come in below and 1% in line. I would say of note, forward estimates are not moving a great deal right now. I think the thing that is most important with earnings is that Q1 and Q2 of next year are supposed to see a very large acceleration in earnings, especially Q2 of next year, which is projected to be by Wall Street analysts up 40% in earnings for the S&P 500. And I think the fear is, are those numbers too high because this economy is going to stall, because there is no fiscal stimulus yet, and because the virus is ramping up again? Personally, the thing I'm most troubled by, and you see it all the time if you walk around Manhattan, is the hit that small business is taking and the number of small businesses that are closing. We still have about 8% of the country out of work. I think that's still a problem.
Well, right, because as much as we focus on the large cap and publicly held companies, Randy, that ultimately the backbone is those small companies. And ultimately, if they come undone, which we've already seen a lot come undone, if that continues and the trends get worse, ultimately that will impact the big cap guys also.
Absolutely, because it'll affect consumers' ability to spend. And that's one of the reasons we need a stimulus package out of Washington. I think, they owe it to small and mid-sized businesses. And I think the market and investors are frustrated that they haven't been able to come to some kind of agreement on that.
So talk to me about small caps. I was crunching the numbers. The Russell's down about 4% so far this year. You've got the S&P up about 5% this year. You've got the NASDAQ up about 26% this year. Russell, though, those small cap names have had quite a rally, up about 61% from that March low. What's your take on this group? What are you seeing? Is there opportunity here?
We think there is opportunity. Normally, small caps are more cyclical than some of the larger companies because they get a bigger portion of their revenues from the U.S. versus overseas. The fact that small cap has started to pick up is actually quite positive. It's actually quite a positive sign for the market. It usually means good things further ahead. I think investors, are starting to get more optimistic that there is going to be a stronger economic recovery next year. I would note small cap has greatly underperformed large cap the last couple of years. Small cap used to trade at a premium to large cap and now trades at kind of parity to a discount. So on a relative valuation basis, right now small cap's actually pretty cheap. So if you feel that the economy is going to pick up next year, you would want to start allocating some money going forward to small cap versus large.
Wait, do you think the economy is going to pick up next year?
I think it is going to pick up next year. My question is when. I am nervous that it's going to be a tough winter, and I'm pretty nervous about Q1 earnings, to be blunt.
Me too.
So then, Randy, call a value rotation for me. When does it happen?
I think it's the second half of next year. For value to get going, you really need two things to occur. You need basic materials and energy to do better, and you need financials, particularly banks, to do better. Now the curve has steepened a little bit recently, but rates are still very, very low. So I think you've got to feel better about banks and about energy prices to get more bullish on value because they're such a big part of the index. Until we start to see those signs, we still want to stick with growth, and frankly, we still like technology.
All right, I know it's hard not to. I mean, not just because it just keeps trending higher and higher, but even the stories, the fundamental stories behind it, Randy, make sense, right?
I think the key on technology is, do you feel more comfortable that technology companies next year are going to hit their earnings estimates, or that the overall S&P is going to hit its earnings estimates? Right now, technology as a group is forecasted to have the same earnings growth as the S&P. I think it has a better chance of making those numbers.
All right, good stuff as always. Randy, thank you so much. Be well. Randy Watts, Chief Investment Strategist at O'Neill Global Advisors, joining us on the phone from Washington, D.C. Kaylee, we're headed for the close, just about 3.5 minutes. We're bouncing off our lows, but we're down across the board.
Still ugly, Carol, and we should note the biggest drags on the S&P 500, big tech companies, Microsoft, Facebook, Google, all down the most.
All right, stick around, everybody. Here comes the closing bell.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. An ugly start to a busy week for earnings. Folks from ProShares virtually ringing that closing bell, and a down Monday for the Dow, the S&P, and NASDAQ. S&P 500 index had its biggest drop in a month on concern rising coronavirus cases will hurt the global economy and as prospects dim for fiscal aid from Washington before the presidential election. Randy Watts is chief investment strategist at O'Neill Global Advisors, and moments ago here on Bloomberg Business Week he told us questions about the election aren't helping sentiment either.
There's a lot of uncertainty about what's going to happen, and I think people, again, are nervous that when we wake up on November 4th, we may not know who won the presidential election, and then there's a question of how long is it going to take to figure that out. Markets don't like uncertainty. Fiscal stimulus uncertain, election uncertain, and COVID ramping up again, another uncertainty.
S&P down 64 points today, a drop of 1.9%. The Dow tumbled 649 points, down 2.3%. To put that number in context, at the worst level of the day, the Dow had been down 965, a drop of 3.4%. NASDAQ slumped 189 points today, down 1.6%. Bottom line, steep losses for the Dow, the S&P, and NASDAQ. Dow Transports down 2.3%. NASDAQ 100 index down 1.6%. 10-year up 12.30 seconds, 10-year yield 0.80%. Gold little changed, up 50 cents, 19.02 the ounce. West Texas Intermediate crude down 3.2%, 38.57 a barrel. Boeing, Lockheed Martin, and Raytheon Technologies all declined on China's plan to sanction the companies over arms sales to Taiwan. Today we saw Boeing shares down 3.9%, Lockheed Martin down 1.6%, Raytheon down by 2.8%. Recapping equities lower across the board, steep losses for stocks, S&P down 64, down 1.9%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Whoa, yeah, what I say.
Nobody move a muscle.
Bloomberg Business Week. Movers and shakers.
Damn, Stiffy, you got to move.
On Bloomberg Radio.
Yes, indeed. Bloomberg Business Week on this Monday. Carol Massar along with Kaylee Lyons. Big picture, if we may. Also joining us is Bloomberg News cross-asset reporter Sarah Ponzak. S&P 500, though, we saw broad-based selling, so only 40 names in the S&P 500 higher today, 464 lower, 1 change. If we check out, Kaylee, those major industry groups, there are 11 of them, all of them down, so down across the board. Utilities did the best, though, certainly considered a more safe haven play there, just down a tad, if you will. Call it unchanged, the group overall for the day. Energy, though, your worst performing major industry group in the S&P 500, down about 3.5%. All right, Sarah Ponzak, let's come in. What stands out for you?
We did see a bit of a classic risk-off trade. Usually on days when we have seen defensive performance, that defensive performance has been technology, but that was not the case today. Instead, we saw utilities, healthcare, real estate, consumer staples. But what really jumped out at me at the same time was that even though we saw big tech head lower, especially the likes of Microsoft down 2.8% ahead of earnings tomorrow, then Facebook, Alphabet as well, also ahead of earnings at the end of the week on Thursday, we still did see that stay-at-home trade make a bit of a resurgence. So I have this stay-at-home basket versus a reopening basket. The stay-at-home basket today outperformed by 4 percentage points. That was the first day of outperformance.
What's in the
5.
stay-at-home basket?
So the likes of Zoom, Amazon, also some home improvement stores, even Domino's due to their home delivery. It was created in the beginning of the pandemic, and it's held up pretty well when we see COVID-19, for example, really drive the headlines. It typically outperforms. And I'm just looking at the best performers in the NASDAQ today on a points basis. You have Zoom up 1.2%, and Amazon flat on the day, mostly up 0.1%. But still just fascinating that we continue to see this trade take hold. And it is understandable considering that it does look like and it does seem as though the leg lower that we have seen in markets today, I mean, one of the steepest down days we've seen in quite a while was sparked by rising COVID concerns over in Europe and now here in the U.S. too.
Well, and a lack of stimulus too, Sarah. I mean, virtually no progress seeming to be made on Capitol Hill. We did hear from Nancy Pelosi, the Speaker of the House's aide, just a bit ago on Twitter saying that she and Mnuchin did talk for 52 minutes. No details from that call. The market seems to have given up hope that something's going to happen before the election, and that's notable in that the sectors that would benefit from an economic recovery, those cyclicals, were at the bottom of the barrel today.
Exactly. Energy, industrials, materials, all down more than 2%. Also, you look at the airlines, for example, that really would get a boost. Royal Caribbean down about 10%. Then we have Carnival, Norwegian. I'm looking at Alaska Air down more than 7%. And it's a bit of a double whammy. Someone asked me earlier today if a sell-off like today would help get Congress and Mnuchin and Pelosi to the table to make a deal. And I said, look, you look back in September and what happened. We are still having this conversation. We had a real correction in the equity market, and that did not bring them to the table. And especially with the election approaching 8 days away, just a day over a week from today, it's a bit of a far reach.
It'll be fascinating to see how, what happens with the economy come 2021. And of course, who ends up in the White House. But, watching whether or not this stimulus package or the delays in it will make the difference between, a faster and bigger economic recovery versus one that lingers and lasts on and will be much more difficult to get out of.
Right, and we did see this reflected in the Treasury market too. You look at TLT, which is the iShares 20-plus year Treasury bond ETF, up close to 1% today. That's the best day since early September, September 2nd. And just after last week, we were talking about this backup in yields. We were talking about the 10-year Treasury yield kissing that 200-day moving average, which is right around 85, 86 basis points. It's just reversed, and now I look at the 10-year at 80 basis points or so. We did dip below that 80 basis point mark earlier today. So it's just such a change in narrative in such a short amount of time. And also, it just goes to show that, yes, stimulus would be so nice and the markets were expecting it. However, at the same time, COVID-19 is the dominant narrative, and that happens to be the very reason why we do need stimulus and why markets need stimulus. And if there is an uncertainty over the trajectory of the virus, and if there's a possibility that we will see more restrictions put on economies going forwards, then that is clearly an issue within itself.
Yeah, I just want to mention a headline crossing. Wells Fargo exploring a sale of its corporate trust unit that could fetch more than $1 billion and is considering whether to find a buyer for its student loan portfolio, according to people familiar with the matter. We know Wells Fargo is one of those cases and companies and banks that is definitely going through a transformation, needed transformation, many would argue, and certainly has seen a lot of pressure. All right, Sarah, thank you so much. Bloomberg News cross-asset reporter Sarah Ponzak joining us with a look at the markets. This is Bloomberg.
All right, Dave, you're up.
Hi, my name is Dave.
Wilson, where are you? Wilson!
Just what do you think you're doing, Dave?
We're going for a price on Wilson.
Open up the door, it's Dave! Who? Dave!
Hey, Mr. Wilson!
I know, Kaylee, we all need like our own little intro theme. I'm just saying.
know,
Dave has the best one. I know. Don't hold your breath. But Dave has a good one. Dave Wilson, come on in with your stock of the day. What do you got for us?
I've got Mirati Therapeutics, Carol. It's a developer of cancer treatments. The company is running 8 trials involving therapies for lung, colorectal, and bladder cancers. Mirati was founded in 1995 and went public in 2013. The ticker is MRTX. Though the company basically has no revenue, it has more than $9 billion of market value. It's one of the 5 most valuable companies in the Russell 2000 index.
That's wild.
It is. I mean, Mirati shares more than doubled in each of the past 3 years.
Right.
They've kept rising this year. Today, they set a record after study data for one of their lung cancer treatments was well received. Mirati's medicine produced responses in 45% of patients taking part in the early stage study. While that may not sound like a lot, it's better than some results for a rival drug being developed by Amgen. And in Mirati's case, almost no one's lung cancer got worse during the study. The results lifted Mirati shares as much as 17%. They closed with a gain of 9.2%.
Listen, this is what we see with these biotech companies, right? And they are, from our own reporting, one of the most talked about names in the biotech space. And if you think about a big pharma company who's looking for something to tack on that's going to show some revenue growth going forward, this might be a takeout target, right?
Yep, shares are up 53% this year, by the way.
Yeah, pretty cool one. All right. Yeah, man is right. All right, Dave Wilson, thank you so much. Dave with his stock of the day. Let's get a check on world and national news heads. let's bring in Ed Baxter in San Francisco. Try not to say headlines. Hello, Ed?
Full news coverage. All right, Carol, thanks. Newark is enacting its own rollbacks.
The city will close all recreation centers to everything but school-related programs for essential employees only. All sports activities and open park practices and games in the East Ward will be canceled.
Mayor Ras Baraka saying a dramatic spike in cases because people have been slipping on the easy things needed to keep it under control. Speaking of control, White House Chief of Staff Mark Meadows is trying to clarify yesterday's comment that the administration had given up trying to control the pandemic.
We're going to defeat the virus. We're not going to control it. We will try to contain it as best we can.
Don't know if that helps. He says a vaccine will do it. Meanwhile, the president is making light of it on the campaign trail.
But look, I mean, I got it, and I'm here, right? I'm here.
And New York Governor Andrew Cuomo lashing out at the administration.
We've got a problem. The Board of Elections was clearly not prepared for this kind of turnout.
I'm sorry. That is Mayor Bill de Blasio. We'll get there in just a second. Let me see if I can bring up Governor Cuomo.
See no COVID, hear no COVID, speak no COVID.
Well, I hope that was worth waiting for. Now, New York Mayor Bill de Blasio says the Elections Commission needs to act very quickly to get control of early voting.
We've got a problem. The Board of Elections was clearly not prepared for this kind of turnout and needs to make adjustments immediately.
Yeah, so that people don't have to wait in line for an hour or more to get a vote. I had that so nicely set up, too. In San Francisco, I'm Ed Baxter. This is Bloomberg.
It's just a Monday, Ed Baxter. It's just one of those kind of days, man.
All day, every day, huh?
Well, you'll get another chance at it.
All
All right. You're listening to Bloomberg Business Week. Carol Masser along with Kaylee Lines. But Ed did mention what we saw in New York City over the weekend, and I was driving around a little bit up in Westchester and definitely saw long lines when it came to voting. You're here in the city, right?
I am. I was one of those 200,000 people that voted this weekend. I waited for over 2 hours. It was pretty cold. The line wrapped around 6 blocks, but I did eventually get to go in and vote. But yeah, I mean, I got there when the polls opened, and that line was already stretching that far. So clearly there's a lot of people getting out there and getting out there early to vote.
Yeah, New York City alone, and seeing nearly 200,000 residents vote early over the weekend, according to Mayor de Blasio. People coming out in unprecedented numbers. Board of Elections, quote, clearly was not prepared for the turnout, according to the mayor. Long lines telling people to go home. And apparently he's calling on the elections board to add voting machines and staff and expand their hours. Like, listen, you have to think about that, right? As we see the voting around the country, we see the lines, you know, making sure that there are the facilities for people who want to vote early to make sure that they can get their vote in.
Yeah, well, and when you have that many people, and you, by the way, need to have social distancing measures in place, I think the reason, one of the reasons the line was stretching so long is we were all trying our best to stay 6 feet apart.
I bet it was tricky, right? You know, it's interesting. There's another great story. Mark Niquette of Bloomberg News. It's out on the terminal and at Bloomberg.com, just talking about how come election night that there's a new statistic that may ultimately be the most important number for people trying to figure out whether Donald Trump or Joe Biden won the presidency. Election officials in key battleground states and at the Associated Press, they are adopting a new measure aimed at estimating how much of the vote has yet to be counted. That's a big part of it, right?
It is.
Because I think in some places, I was listening to David Weston earlier on Bloomberg Radio, that you can't start the count exactly for those early votes until Election Day, right?
Yeah, it varies by state, but there's clearly been a lot of early votes cast, nearly 60 million. 60 million, Carol. That's a lot.
It's amazing. It is a lot. This is Bloomberg.
headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. The virus is spreading. Stocks are tumbling. S&P had its biggest loss in a month as concern rising virus cases will hurt the global economy. Also, prospects dim for fiscal aid from Washington before the presidential election. Bottom line, stocks lower but did finish off session lows. S&P ended the day at 3,400, down 64 points, down 1.9%. At the worst level of the day, the S&P had been down 100 points, a drop of 2.9%. The Dow Jones Industrial Average down 650 points, down 2.3%. Nasdaq down 189, lower by 1.6%. 10-year up 12.30 seconds, 10-year yield 0.80%. Gold up 33 cents the ounce, 19.02. Little change there. West Texas Intermediate crude down 3.3%, $38.55 a barrel. Bottom line, down day for the U.S. stock market. The Dow, the S&P, and Nasdaq all declining. In this headline to pass along to you, AIG says it will pursue a separation of life and retirement business. I'm Charlie Pellet. That is a Bloomberg Business Flash.
So it is the final week before Election Day in the United States, the U.S. presidential election. It is now, check this out, 7 days away. More than 58 million and counting Americans have already voted. Kaylee among them, my husband among them, and so many more. Charlie Vollmer, though, our head of technical operations, not so much because he said the line was too long. It is more than voted earlier absentee in the 2016 race, so there's some perspective. Let's get into this because what's interesting is that there's a fascinating story on the Bloomberg that says that while President Trump is hoping to repeat his upset victory over Hillary Clinton with an electoral map that looks like 2016, his problem is that the map is looking a lot more like 2008. Let's get into this with Bloomberg News national political correspondent Gregory Cordy. He joins us on the phone from D.C. Gregory, good to have you here with Kaylee and myself. Explain this. What do you mean?
Well, I think President Trump so sort of reshaped our vision of what was possible politically that we forgot that it was sort of an aberration of what the trend had been. Certainly, President Obama in 2008 and again in 2012 won states in the industrial Midwest, not just the Pennsylvania, Michigan, Wisconsin that we keep talking about because those were the blue wall states that President Trump snatched from Hillary Clinton, but also Obama won Ohio, he won Florida, he won North Carolina once, he won Iowa once, and on his way to 365 electoral votes. And so that's the map that may end up looking more like the map that we see next Tuesday if Joe Biden can reassemble the Obama coalition and make 2016 look more like an aberration than the new normal.
Okay, so if that's not the way it's going to go, though, if Trump wants to win the college, who does he need to win over most to form that coalition?
Well, he's got to hold that 2016 map, and he can afford to lose maybe, two of the blue wall states. The polls are not looking good for him. Certainly, he has fewer paths to victory than Joe Biden does. He really has to thread the needle, to draw the inside straight, to, whatever metaphor you want to use. And look, he did it once, and that's the number one argument for a Trump victory in 2020 is that nobody believed that he could do it in 2016, and he did it. But the polls would have to be off even more than they were in 2016. They really, so much more would have to go his way. And again, let's not forget, we're in the middle of a pandemic. The economy is not performing as anyone would like.
Right.
And so he really has an uphill battle here.
So is this going to be fundamentally different from 2016? I feel like a lot of the murmurs in the background have turned into, well, what if this is the same thing all over again? The polls are wrong, and he is going to pull up this upset victory. What's different that makes that not the case potentially?
Well, people talk a lot about these shy Trump voters, and there's still a big argument in academia and among pollsters and among journalists and pundits whether shy Trump voters ever existed in the first place. But certainly, even if they did exist,
the reason why pollsters were not able to take them into account is because they didn't have a voting history. Well, now they do have a voting history, and so pollsters can match their responses up to those voter records and see whether these people voted in 2016 or not. So that's one difference. And again, we have an economy that is much more like the economy in 2008 that helped Democrats win that 2008 Obama map. Unemployment is about where it was at this point in October 2008. Now, it's going down now, and it was going up then. But you see the same sort of economic concerns in the Rust Belt as you had in 2008 that helped President Obama and his running mate, let's not forget, Joe Biden, get elected.
Right. And of course, those shy voters are those people who don't necessarily say they're voting for Trump, but they do ultimately when they go to pull the lever. So, I mean, that's what you're talking about. What's interesting, too, though, Gregory, is, when we think about how Joe Biden and Barack Obama got to the White House in 2008, it was women, it was black voters, and it was, those voters in some of those struggling states, as you point out in your reporting, whether it was the Midwest and some of the states out west and also in the South. I mean, those are some that Trump was able to garner when he ran in 2016. So can we safely say that those are going to go to a Biden, vote here?
Yeah, we call it the Obama Coalition, and it was young people, it was African Americans, it was progressives, but also marry that with the more moderate wing of the party, union voters, those working class voters that President Trump did peel off in 2016, especially in those states that are heavy on manufacturing. And you're absolutely right. That's going to be the key question, whether Trump keeps those voters that voted for Obama twice and then decided to take a chance on Trump, or whether they go for Biden. Now, Biden has a long history with supporting labor. He has endorsements from the key labor unions. Now, so did Clinton. But the question is, Biden is not Clinton, and Clinton had a lot of negatives, for better or for worse, and we can relitigate what happened in 2016. But Biden does not seem to have the high unfavorable ratings that dogged Hillary Clinton through that campaign.
Yeah, and it's very different. This is, not candidate Donald Trump. It's President Donald Trump running on, whether or not you think that he did, you liked what he did during those 4 years in the White House. It's a different environment, safe to say. And of course, you've got COVID-19 also as the backdrop. Gregory Cordy, thank you so much. Really appreciate it. Bloomberg News national political correspondent joining us on the phone from D.C. I mean, I feel like there's so much at play here, Kaylee.
Yeah, there absolutely is. And the conversation also is how many minds are left to change, because President Trump, as a candidate and a president, has been very polarizing. A lot of people have already made up their minds.
Yeah, exactly, right? They've already placed their votes. All right, you're listening to Bloomberg Radio.
Broadcasting live to New York, Bloomberg 1130. To Washington, D.C., Bloomberg 99.1. To Boston, Bloomberg 1061. To San Francisco, Bloomberg 960. To the country, Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
You're listening to Bloomberg Business Week on this Monday. I am so looking forward, Kaylee, to this next guest. I caught up with him last week at Milken virtually. Jonathan Goldstein, CEO at Kane International. We talked about global real estate, and he has a great perspective there on the ground in London, but really watching the whole world.
Yeah, he's all over the place, including in Miami, where has a commercial development underway. And I'm interested to see, commercial real estate, not exactly a place you want to be right now.
Yeah, it's a tough one. All right, we'll get to him in just a moment. Let's get back to Charlie Pellet with some news after the close. I was like, wait a minute, what's your name? It's a Monday brain. It's
Heard
totally
that many times before in my life. Here's what's going on. AIG shares are rallying after hours, says it will pursue a separation of its life and retirement business. AIG up now by just about 5%. No decisions have been made as to how to achieve full separation, according to the company, but it says the intent is to establish two independent companies. AIG also naming Peter Zaffino as CEO effective in March of 2021. Again, AIG shares, they are rallying after hours. Wells Fargo says it's exploring a sale of its corporate trust unit that could fetch more than $1 billion and is considering whether to find a buyer for its student loan portfolio. This, according to sources. Wells Fargo shares, they are down now by about 2.5%. A down Monday with the S&P posting its biggest drop in a month on concern rising coronavirus cases will hurt the global economy and as prospects dim for fiscal aid from Washington before the presidential election. S&P 500 index lower today by 64 points, down 1.9% at the worst level. The S&P was down 100, down 2.9%. The Dow down 650, down 2.3%. Nasdaq down 189, lower today by 1.6%. 10-year up 12.30 seconds, 10-year yield 0.80%. Gold, little change, down $1 the ounce at $19.01. West Texas Intermediate crude tumbled 3.3%, $38.54 a barrel. Well, as for the fourth quarter economic outlook, David Page is head of macroeconomics at AXA.
So for us, we've been spending the last sort of 4 weeks really downgrading that outlook for Q4. I mean, Q3 still looks good. Q4 we've been reducing. So in the US now, we've got a quarter-on-quarter view of just under 1%. We're looking at about 0.8% coming in for that final quarter. Of course, it does depend a little bit on the momentum coming out of Q3. We'll learn that towards the end of this week when we get the Q3 numbers.
RV shipments climbed 31% in September to 41,509 vehicles from 31,639 a year earlier, boosted by demand for folding camper trailers and van campers. This according to the RV Industry Association. Among some of the RV names today, we did see a mixed picture for a lot of the stocks. However, shares of Winnebago did advance today by 0.1%. Thor Industries down 0.6%. Camping World down by 3.1%. And that's a Bloomberg Business Flash.
Is indeed Charlie Pellet. Thank you so much. Well, you heard some of the discussion from the Milken panel I hosted last week. We aired it on Bloomberg Radio on this show, Global Real Estate in the Eye of the Storm. That storm, of course, being the global pandemic. One of the participants, Jonathan Goldstein, he is CEO of the London-based Kane International. They've got properties in the UK, in the US, around the globe. The firm partly owned by the owner of the LA Dodgers, by the way. Delighted to have back with us on air Jonathan, and he joins us on the phone from London. Jonathan, it is good to have you here with us. I really felt like I learned a lot talking to you and the others that were on the panel. How are you?
Yeah, I'm good. Thank you, Carol, and thank you to Kate. Thank you for having me. And it would be a miss, as you referenced, Todd, for me not to wish the Dodgers good luck in the next game to hopefully clinch the World Series.
It's a big one. It's a big one.
I'm one of the few people in London who wakes up in the middle of the night and the first thing I do is look at my MLB app to see how the Dodgers are doing.
Todd Bowley thanks you for doing that. So tell us a little bit, like I said, we aired a little bit of the panel on Bloomberg Radio last week, but for our full audience, tell us a little bit about what you guys are seeing in London and what you're watching around the globe, especially as these virus numbers tick higher.
Well, I think it's, London and England has got an uptick in diagnosis and positive tests over the course of the last 6 weeks or so, and as I'm sure you've seen, England's been sort of divided up into various tiers, and they're closing down various of the cities as they go higher up in the number of infections. London has remained under some level of control. But I think it is also fair to say that the centre of London, just like the centre of New York, is not what it was. And there isn't the level of buzz, there isn't the level of activity, there isn't the level of excitement that we all enjoy living in these wonderful cities. But we have to hope that this is a blip and that this is a situation that will refresh itself and resurrect itself as time goes on. I think, as you and I discussed last week, as we wait for a vaccine and we have no idea when that will take place, I think it really is an issue of testing. Testing to give people confidence that they can be in environments where infection won't spread. So I'm all for testing. I think that it's great that we get as much testing as we can, because I think that's the way our cities rebuild.
Right.
And rebuild they must, and rebuild they will, because it's for the benefit of all of our people that that the great cities recover to the strength that they saw previously.
Jonathan, I think I asked you, the panel was entitled, Real Estate in the Eye of the Storm. And I said, are we still in the eye of the storm? Or are we on the other side of it? And I thought you had said that we still have a good, maybe, is it 6 to 9 months to go to get through this?
Yeah, I believe so. I've always, I listened to Bill Gates right at the beginning of this process. And he's cleverer than me. He's cleverer than most, isn't he? And he said that he thought it would be a minimum of 12 to 18 months before we could have something reliable to rely upon. That was in March 20. So I think we have to assume that we're here in a pretty same state as we are now through the second quarter of next year. If we beat that, then that's fantastic. But I think we need to build our businesses and set our expectations and our staff's expectation based upon that timeline.
But
we have to stop being unrealistic.
But it's going to be different come the second quarter, right? It's not that the market is just going to bounce back to what it was back in 2019. How has it been fundamentally altered?
No. Look, the thing about this, the COVID, is that COVID, in a medical sense, attacks the weakest points of people's being. I had it in March. I was lucky enough not to be overly affected, but we all know so many people who unfortunately underlying vulnerabilities or attacked. That is the same way in business terms. COVID has affected retail and other weaker property areas, which were, in a state of decline, and it just has accelerated them. Now, we've always had a flexible working environment for the last 10, 15, 20 years. This has accelerated it hugely. The use of technology has accelerated that process even further. But that doesn't mean to say that these things are over. That's the wrong reaction. It's the wrong reaction to suggest that office life is over as a result of the pandemic, because people enjoy the vibrancy of conviviality and of human interaction. And
John,
that's not going away.
John, hang on for a second, because we've just got to do a little bit of news, but I want to come back and explore this point a little bit, because I think we do wonder about working from home. How does this impact all of us going forward? We're going to get back to the CEO of Kane International, Jonathan Goldstein, in just a moment. Ed Baxter, take it away.
All right, Carol, thanks. So many people wanted to vote in New York City over the weekend that it clogged the system.
For years and years, New Yorkers have been waiting for a moment to express their views on the direction of our country, waiting through such difficult times, through this pandemic, through all the pain, all the challenges.
Yeah, now Mayor Bill de Blasio saying the surge caught the Election Commission process flat-footed.
Long lines tell people to go home. That's just the reality. Long lines at a poll site discourage voting. They don't encourage it.
Waits over an hour, says needs to be fixed right now. President Donald Trump on the campaign trail.
You watch these polls and you say, oh, this is terrible. They're fake polls. They're fake. They're total fake. These are real polls. We're going to win in Florida. We're going to win in Pennsylvania, I think.
Meanwhile, his administration now says it will not release his tax plan before the election, despite continued promises to do so. Vice presidential candidate Kamala Harris says the Biden plan is just very simple.
We will not raise taxes on anyone making less than $400,000 a year. Period, full stop.
Yeah, period, full stop. Harris on ABC. The WHO out today saying the globe is experiencing pandemic fatigue and is having a disastrous result. WHO Dr. Maria Van Kerkhove says Europe, it is close to disrupting everything and people getting care. In San Francisco, I'm Ed Baxter. This is Bloomberg Radio.
All right, Ed Baxter, thank you so much. You're listening to Bloomberg Business Week. Carol Master along with Kaylee Lines. And one story that caught our attention by our Shonali Basic has to do with, I believe she caught up with Wall Street veteran Peter Krause, and he said individuals in the U.S. are unlikely to face higher taxes on their wealth despite a push by Democratic leaders to raise more revenue that way. We've heard certainly Vice Presidential candidate Joe Biden, presidential candidate, I should say, former Vice President Joe Biden, talk about this as a way to certainly tax the wealthy and bring in some new revenues to the government. But this is kind of, we're all watching this.
Yeah, we are. And it's not just about the wealth tax either. Biden has promised to raise the corporate tax rate to 28%. That is much buzz about on Wall Street. Though it's interesting, Krause is kind of taking a different view than many strategists on the street. Krause saying higher taxation is going to mean lower stock prices. But Goldman Sachs, the chief equity strategist over there, David Kostin, just put out a call today saying that isn't the case, that if you look back at history, even when corporate taxes are raised, stocks may react in the short term, but they do bounce higher shortly thereafter.
Right. It's more about the economy and whether or not these companies can do well. And I mean, I think that's really important. What's fascinating about this story by Shonali, it also talks about SALT, which we're talking about the state and local tax deduction, which we know was part of Donald Trump, President Trump's tax overhaul package. And what the thinking is with the Democratic group in charge, it's possible some, maybe all of that state tax deduction will be reinstated with a higher tax rate. So it's interesting, something we're watching. We know states need revenue, but I know I'm in one of those states that got impacted by your state and local tax deduction. So it'll be interesting to see if indeed we get a Joe Biden White House, whether some of that changes ultimately in terms of tax policy. So certainly something we're going to be watching, especially as states, municipalities are also under pressure because they've all been impacted by the virus in terms of their revenues, Kaylee.
Yeah, I mean, it's a cash drain to put out these resources, and you don't have as much revenue coming in considering the state of the economy, the state of everything. So they are definitely in dire need of cash.
All right, certainly something we're watching. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We begin with a developing story after hours. AIG, American International Group, has named Peter Zaffino as its next chief executive officer, and it will split off its life insurance business. Zaffino is the firm's president. He will take over the top job on March 1st. We've got shares of AIG. They're pushing higher after hours, up now by about 3.5%. It was a down day on Wall Street today with the Dow, the S&P, and NASDAQ kicking off a busy week for earnings with losses. S&P had its biggest drop in a month as concern rising coronavirus cases will hurt the global economy. Also, prospects dim for fiscal aid from Washington ahead of the presidential election. Today, the S&P 500 index tumbled 64 points to 3,400, down 1.9%. The Dow dropped 650 points, down 2.3%. At the worst level, the Dow had been down 965, down 3.4%. NASDAQ tumbled 189 points today, down 1.6%. 10-year up 12.30 seconds, 10-year yield 0.80%. Gold little change, down 36 cents the ounce at $19.01. West Texas Intermediate crude down 3.3%, $38.54 a barrel. So again, recapping, stocks lower, S&P down 64, down 1.9%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Want to get right back to our guest. I'm Carol Master along with Kaylee Lyons right here on Bloomberg. Jonathan Goldstein is with us, CEO at Kane International. He's on the phone from London. So, Jonathan, just before we did some news, you were talking about working from home, and you are convinced that we're not going to, this isn't how it's going to be forever. People are going to want to go back to work. Is that fair?
Yeah, I think that's a good way of putting it. My friend Sandeep Mathrani, the CEO of WeWork, describes working from home as the privilege of the privileged. And I think that that's been seen through the whole period of the pandemic. In a recent poll by the London School of Economics, 37% of Londoners were found to have been working and sleeping in the same room. 4 in 10 worried about their mental health. Half of young workers were worried that working from home would hamper their career development. 85% of 1,500 office workers said they struggled with the switch to home working, and so on. I think we have to get out of this narrative that this is good for people. Flexible working, giving people control over their destinies, treating people like equals, treating them like adults, that is a positive step. But believing that people are going to do better and are going to enjoy their lives by sitting in the same room, sleeping, eating, drinking, working, it's not good for people's mental health, and it's not good for companies. Show me a great company that was built by a disparate workforce being spread around many, many, many cities.
Right.
I have never seen one. What I've seen is great campuses of businesses, great offices of businesses, great environments, which thrive through the energy and the vitality of their people. Great people. That's where I think we will end up.
It's a very fair point, Jonathan. I guess my question to you is, even if people return to the office, are they going to return to the cities? So much of what we've seen in this pandemic is people fleeing to the suburbs, buying bigger houses. And I see in your portfolio, you are invested in a lot of residential towers in cities like Miami and New York. You think people will come back?
Well, in Miami, we have got residential towers, and we've also got an office development. We've been amazed by the demand for the office space that we've seen through major companies migrating from, let's say, New York and other major cities down to Miami. And we've seen great demand for the residential product. I think there is no doubt that there is an issue with the vast amount of multifamily, in particular in New York, that has spurted up over the course of the last 10 years. You can see that by the offers being made to their residents in terms of free time and other offers over the course of the last few months. And there is no doubt that that product is going to struggle in the major cities, particularly New York and maybe even London, over the course of the next year or two. But let's not bet against our major cities. Our major cities are there because of the vast range of attractions that it provides to people. Be it sport, be it entertainment, be it museums, be it culture, be it the whole ability for young people to grow their lives. It's a centuries-old notion that people were attracted to the cities. So I don't think that's going to change. We might see a short-term blip of people migrating away, but I think if you and I have this conversation in 2 years, in 3 years, in 4 years, we'll say, what made us doubt New York? What made us doubt London?
Yeah. And what's interesting, even though while so much of the hospitality industry, which is something really closely, some areas, we talked to somebody, a real estate developer over in Aspen, and they were doing well. That's where they were flocking to. So it's listen, location. We know it's not just.
We have a development in the French Alps. It's exactly the same. But of course, certain of the developments, certain of the hotels around the world are really struggling. Tourism is down by tens of percentage points.
Yeah.
The major hotel groups who were operating at an average occupancy of 80% at the back end of quarter of 2019 are looking at average occupancies in the 30s today.
Yeah.
If there's a huge drop in business travel and there's a huge drop in leisure travel, that's obviously going to have an impact on the hospitality industry. And if you were to predict the two aspects of real estate that would suffer the most distress over the course of the next 24 months, that would be the retail, we all know what that story is, and the hospitality areas. Because I'm afraid there'll be many, many weak products that do not survive this situation. And you've already seen the very large Hilton at Times Square announce in September that it would not be reopening.
Right.
We've seen hotels in London announce they're not reopening.
Right.
So I think you're going to see products really suffer, but the great products will survive and prosper.
And I feel like
struggle.
Well, and I feel like, Jonathan, with retail, it was already, we know, overstored, and we knew, it just kind of